In this presentation, we will work part one of a fairly comprehensive problem related to the Capital Projects Fund and the government-wide activities, journalizing transactions in the Capital Project Fund and government-wide activities, and then posting them to a worksheet. We'll typically be starting out with the government-wide activities. Government-wide activities you can think of as the entity as a whole, typically being on an accrual basis, therefore being something we're more used to, more familiar seeing. Then we'll take that transaction on an accrual basis and think about how we can piece it together, what it will look like, if anything, in terms of the fund accounting. First item is that we're going to issue bond anticipation note for the capital project. So we have a capital project, we're going to issue a bond anticipation note. This will look like a normal type of transaction when we're going to finance a project. So we can imagine here that we have a capital project, we need money now, we're going to issue bonds, but the bonds are going to be issued in the future. We'll have a lot of money once we issued the bonds, but for now we need a short-term note in order to tide us over until that point. Therefore, we're going to have the note, and it's going to be the anticipation note payable. Cash is going to be increasing, bond anticipation note. We're going to increase the cash. There we have it. The other side going to a payable account. There's going to be the debit. There's going to be the credit. Should look fairly familiar on just about any type of note. This would be a normal kind of note that we would be taking out, cash going up, the note payable on the other side. What's this going to look like in our fund type of accounting? It's going to go to the capital project fund because that's why we're financing this. We're financing this to make a capital project like a building or a library or a bridge or something such as that. So the cash, you would think, would go up in the capital project fund, but we're highly suspicious about the other side, the note payable. If it's a long-term note payable, typically we won't record it in the capital project fund because that is on the modified accrual basis, not using the accrual basis and therefore not having the long-term liabilities on it. Now this one we might think is a short-term note, but it's being anticipated to do further financing, issuing a bond, which is another form of basically financing. Therefore, when we go to the capital projects fund, as we're here now, we're going to record it as an increase to cash. Other side not going to a payable, not going to a liability, but going to other financing sources, proceeds from bonds anticipation note, kind of like an income statement account, increasing the temporary type of account. So cash then going up, cash is going to be increasing with a debit. The other side then being a credit, that's going to be increasing down here, similar to the revenue accounts, acting like a revenue account, other financing sources, proceeds of the bond anticipation note. Let's see the next transaction, back on over to the government-wide activity. We now have architecture and engineering costs for two projects. So two projects, we have Project B and Project F. These are going to be our construction projects that we are going to be tracking in the Capital Project Fund. We're now in the government-wide activity. The transaction then on an accrual basis is that we're going to be working through this as we would in, say, a job cost type system where we're going to be anything related to these jobs, increasing the asset of those jobs, not expensing them, because we're going to eventually capitalize these assets as whatever it's going to be built, say a building. So we're going to be debiting work in process type accounts, work in process for B, work in process for F, the two projects we're working on. The credit then going to vouchers payable, liability for what is owed. So this should be kind of normal, typical type of looking transaction for, say, a construction project, for, say, a job cost type system. So we have the work in process for B and F, debiting those items. The other side then going to the voucher payable. So we're recording these out, two debits to the work in process, the credit going to the voucher payable. This is what we would typically expect. What's going to happen in the fund accounting side, we can take this apart, think about what's going to happen in terms of the fund accounting. This is going to go into the capital project fund because we're clearly working on capital projects. Capital project fund, however, on a modified accrual basis. Therefore, we're not going to be recording the construction work in process in the same way as an asset because that's a long-term asset. If we then move to the capital project fund, then we have the construction expenditures for B, construction expenditures for F, and then we have the same voucher payable. It's going to be a payable because it's short term. It's a payable type of activity, not a long-term financing type of activity. So now we're recording these two items rather than as an asset, as the flow, because we're tracking the activity in the capital project fund. Recording this out, then we have the expenditures for B and F. Those are going to be down here, increasing. The similar to expense type of accounts, the expenditure temporary accounts, those that'll close out. And then the other side going to the liability account as it did in the government-wide activities, increasing that liability account in the capital projects fund. Now we're going to say that we have a construction contract for B and F. So we've signed in or put into a construction contract. We are the government. We have a contractor that we have an agreement with now to construct our capital projects B and F. Within the government-wide activity, no transaction. Why? Similar to having like a purchase order. A purchase order, when we send out the purchase order, we're requesting inventory. We haven't got the inventory and we haven't paid for the inventory. No financial transaction, although we track the purchase order and expect to receive inventory in the future. Same item here. We've got the estimate for what the project will be. Project's not built and we haven't paid for it yet, therefore no financial transaction on an accrual basis. However, when we go to the capital project fund, we want to record the fact on the financial statements that we have assigned out the contract. Therefore, we're going to use the account called Encumbrances. So this is going to be similar to like a purchase order in like the general fund. We're going to have the contract, the estimate has happened. Therefore, we're going to debit encumbrances for B, debit encumbrances for F. The other side is going to go to the outstanding, encumbrances outstanding, which we're just going to stuff into the similar as the equity side type of accounts. So we're going to say that the construction encumbrances for B and F are going up. Again, I would think of these as clearing accounts. So they're not really temporary accounts in the same way that all the rest of the blue accounts typically will be, or in that normal income statement accounts will be, in that they close out to the equity section, or in this case to the fund balance section. But they're going to close out when the expenditure has taken place. So when we're able to record the expenditures under the modified accrual basis, we'll reverse the encumbrances. So that's why I would think of it as a holding account. These increase in the same way as basically an expense does, because they're holding the place for the expense that we will record in the future. The other side then go into the equity. So here's the equity accounts in the encumbrances outstanding, increasing in the credit direction. Those always being equal and opposite, equal and opposite, equal and opposite. Back to the government-wide activities. Next transaction, we issued a bond. So we issued the bond at 101. So we're going to issue it at a premium at 101% of the face amount. The rate is going to be 6%. In the government-wide activities, the normal accrual accounting, it should look familiar. We're going to put the bonds on the books at the face amount. We're going to collect cash at 101, which is going to be 29,000,000 times 1.01, or the 29,290, and that's going to be the debit to the cash. And then the credit is going to be the premium, because we got more cash than the face amount of the bond by the 290,000. Recording this in the government-wide activity then, cash increasing, so cash is going up with a debit. Then we've got the bonds payable down here. It's going up in the credit direction. And then we have the premium on the bonds payable going up in the credit direction as well. Now that we have the government-wide activity on the accrual basis, we want to pick it apart and say, okay, what's going to happen on the fund accounting side? This is going to go to the capital project fund, because that's why we issued the bond, so that we can finance the capital project. And so if we go through this, we're going to say cash is going to be affected in the capital project. However, we typically record the cash in the capital project at the lower of the cash received or the face amount of the bond. In other words, if we issue the bond at a premium, we'll typically record the face amount of the bond. If we issue the bond at a discount, we'll have to record the cash amount, because it'll be lower than the face amount of the bond. So in this case, we had a premium. We're going to record it at the face amount of the bond. The financing of the bond, we're going to assume is going to be done in the debt service fund. We're not going to go to the debt service fund right now. We're concentrating on the government-wide activities and capital project. We will take a look at the debt service fund in a future presentation. So we have the capital projects fund then recording a debit to the cash for the face amount of the bond, and a credit to other financing sources. We're not going to be crediting bonds payable. That's a liability account, long-term liability, not something on the modified accrual basis, which only has the current liabilities recorded there. Recording this transaction, we're going to say that cash is increasing. Here's cash going up in the debit direction. Then we have the other financing sources acting in a similar fashion as revenue would. It increasing in the credit direction. Next item, we're back to the government-wide activities. We're going to say that we paid bond anticipation note outstanding. So we paid the bond anticipation note outstanding. It's outstanding for 180 days. In other words, now we have issued the bond, so now we can retire the bond anticipation note because we've got the financing from the bond. So you'll recall that the bond anticipation note is going to be on the books. It's right here. It's that $110,000. We're going to pay it off. We're also going to have to pay the interest. Now the interest rate, as we saw in the prior, when we put the bond on the books, is 8%. We're going to say that we had the bond for 180 days. We're going to use 360 days in a year. There's typically 365 days in a year, but 360 is even. 12 times 30, 360 days. So we'll calculate then the interest on it. It's gonna look like this. We're gonna say that we have the amount of 110,000 times 8%, 0.08. That would be for a year. Then I'm going to divide by the number of days in a year, rounding it to 360. 12 times 30 divided by 360. So there's per day interest. Then we're going to multiply that times the days that are included here in the life so far that have been passed, 180. And then that's going to be the interest we're going to have to pay. So we're going to take this off the books. We're going to debit the bond's anticipation note, the note payable, to make it go down. We're also going to debit the interest for the $4,400, and then we're going to pay the cash then being the $114,400, the 110 plus the 4,000. If we post that out, then we're going to say that the cash is going to be going down. Here's the cash going down. The bonds payable, or the note payable, is going to be going down for the bonds anticipation note to 0. And then we were going to record the interest expense. That's going to be the cost of the loan on the books at the $4,400. This should look somewhat familiar when we pay off the loan. Now we want to think, okay, what's going to happen in terms of the fund accounting? We finance this for the capital project fund. So we're going to have the same kind of cash is going to be having an item in cash, but we're not going to have the bond anticipation, the note payable, because we didn't put the note payable on the books because although it might have been short term, it was there to finance the bond, and therefore it wasn't going to go on the modified accrual basis. So we're going to have to do something else with the bond's anticipation note. The interest is something that could be recorded in terms of the capital project fund. So it's going to look like this then, the transaction. Rather than the note going down, we're going to record this to other financing uses, and that's going to be the $110,000 interest expense on the debit, and then we're going to credit cash of the $114,400. If we record this out, then we're going to say cash is decreasing, so cash is going down. Then we have the other financing uses acting like an expense. So here's the other financing uses going up in the debit direction. Then we have the interest expense going up in the debit direction as well. Of course, acting like an expense, or expenditure, I should say. It's acting like an expense. It's in the modified accrual basis for the capital projects fund, therefore interest expenditure. Back to the government-wide activities. Now we have invoices received for P project. So P project, we have invoices received. P project is a capital project, and therefore in the government-wide activity, any invoice is going to go towards the thing that we're making, the capital project we're making, in this case, a building, some type of long-lived asset, and therefore we're going to put it into the work in process account. So we're going to put this into work in process for B and F. So this is the invoices received for the two projects. So we're going to increase the work in process asset account, and the other side's going to go to a payable because we owe it, we haven't yet paid it, and that's going to go to a credit to a payable account. If we post this out, then work in process accounts, B and F, increasing with the debits, the other side then going to contracts payable, a liability account, increase in the liability account. So that's in the accrual basis. Now we're going to think about what would happen in the fund accounting. Obviously, we will be recording this in the capital projects fund, but we're not going to be debiting the construction work in process because that's going to be a long-lived type of asset. So that's not something we're going to debit. Also, we're going to have encumbrances when we put the project on the books in terms of the contract that was started. We're going to have to reverse the encumbrance and then put this on the books, but not as an asset, but as expenditures. Let's take a look at what that would look like. We got the same information. We're now in the capital project fund. First, we're going to reverse the encumbrances. So we're going to say that these are the encumbrances that are going to be related to the invoice that we have, and they're going to be the same amounts here. So we have the encumbrances on the books. They're not completely done yet, but we're going to reverse this portion of the encumbrances. So the encumbrances have encumbrances outstanding, and then the encumbrances. Encumbrances outstanding is a credit. We're going to debit them then to reverse it, because remember, these are just the holding accounts that we put on the books to hold basically an expense type of account before we can actually record the actual expense or expenditure and the modified accrual. Now we can record the actual expenditure, which is going to be the construction expenditures. But before we do so, we have to remove what I would call the clearing account, which is going to be the encumbrances account. So we're going to reverse these amounts. We've got to reverse or debit the encumbrances outstanding for B and F projects, credit encumbrances for B and F projects, reversing that portion of them. So we have the encumbrances outstanding, then have credit balances. We're going to debit them, making them go down. So those are the debits. And then in the encumbrances, we're going to say these have debit balances. We're going to credit them to make them go down. They're not going down to zero because we haven't finished the whole project yet. So we're just decreasing the amount that has been invoiced for up to this point. Now we can then go in and record the actual expenditure in a format that we would kind of think would be normal. So again, under a accrual basis, under a job cost system, we would debit an asset. But of course, we don't have long-lived assets on the capital projects fund. We're tracking the activity, so we're going to put it to the construction expenditures for project B and F, and then credit the contract payable in a similar way that we did in the government-wide activity. So if we record this, then we've got these two expenditures. So they're going to be debits, increasing the expenditures like an expense, increasing. And then the other side going to the contracts payable, that's going to increase the liability account in contracts payable. Back to the government-wide activity. Now we're going to say that we got a grant. A grant was received for the capital project. So grant was received from somewhere outside of the government entity. We don't have to pay it back. Therefore, it's the type of revenue account. So cash is going up. That's straightforward. Cash increases. The other side's going to go to some type of revenue. We're going to call it economic development for the capital grants. So if we record this, then we're going to say cash is going to be increasing for the grant that was received for the capital project. The other side's going to go to some type of revenue account. So revenue then increasing in the credit direction. That's what's going to happen on the government-wide activity. Now we want to think about that and say, well, what's going to happen on the fund accounting side? The grant was for a capital project, so some type of building that we're making or something like that. Therefore, it's going to go to the capital project fund. The cash is going to increase. The other side's going to be revenue, pretty straightforward. Under the capital project, pretty much the same type of transaction, because this is a fairly straightforward transaction. Cash is cash. The other side's going to be revenue. So we're going to say cash is going to go up. The other side's going to be the revenue. We're just naming the revenue, slightly different name in the capital project. So cash is going to increase. Here's the beginning balance. Here's the debit, increasing to cash. Then we have the revenue. Here's the revenue. It's going up with a credit. Here's going to be the credit balance in the capital project fund. Back to the government-wide activity, we're going to say now that we paid the construction invoices less a retainage of 5%. So now we're going to pay off the contracts now. We have the contracts payable. It's typical to retain some of it because the job's not done yet. So we're going to pay off some of the contract, but we're going to keep some of it so that, and we'll say, hey, you already did this work, but we don't want you to take all the money and go. We still owe you this money, but we'll give it to you when you finish the job. So that's going to look something like this. We got the $15,000 liability. We're going to debit it to make it go down, but we're going to keep some of it and still have it owed. We're going to move it then to the contracts payable retained portion. And that amount is going to be the 15 million times 5% or 0.05. And that's going to give us our 750,000. So we're going to say, we're going to take this off the books. We're going to put it on another liability at the 750. Then the cash we're going to pay is only going to be the 14,250,000. Recording this out, then we're going to say that the cash is going down by the 14,250,000. The contracts payable, we're going to debit it, taking it off the books entirely. But then we're going to record another liability, which is contracts payable, the amount that we retain. and we're going to say, hey, that's 750. We know we owe you that. We know you did the work already. We want you to keep doing the work, complete the job. We'll pay you that upon completion, along with any other added billing that's going to happen at that point in time. So then we want to think about this and say, well, what's going to happen on the fund accounting side of things? And it's going to be looking much the same in the fund accounting, because we have the liability on the books because we're considering this part of the project, and therefore it's going to be short term typically. It's not part of the financing of something like bonds. So we're going to have much the same type of activity in the capital projects fund. We're going to take the contracts payable, we're going to reduce that amount, we're going to record the retainage, and then we've got the cash going down. So here we have that. Once again, contracts payable is going to be debited, making it go down to 0. We're going to retain 750 retained. Then we have the cash being credited, decreasing the cash amount. Next transaction, we're going back to the government-wide accounting. We're going to say that we completed Project F. We have a final invoice, that final invoice being for the $7 million. So first we'll record the final invoice. So the final invoice is going to be a debit to the construction work in process. This is on an accrual basis, job cost system. We're going to increase the work in process account. And then once it's done, we'll transfer it out of the work in process to the finished product, which in this case is going to be the building. And then we're going to credit the contracts payable. So if we see this, we're going to say, all right, we're going to debit the work in process for F. That increases the work in process with the debit. Then we're going to credit the contracts payable. So we credit the contracts payable on the liability side, and there is our credit. Now, when we consider this, what's going to happen on the fund side? We've seen a similar transaction to this already on the funds and the capital projects fund. We're going to record the construction or the debit, but not to the asset account, because under the modified accrual, we don't have it. We're going to be recording the debit to some type of similar expenditure type of account. And we'll also have to reverse the encumbrance before we record the expenditure, because the encumbrance will have the holding account recorded to hold the place of the expenditure until the expenditure is recorded, which will be at this point in time. Now, however, we're not going to go to the capital project fund. We're going to stick on with the government-wide activity, because this says that we have completed the project. So we completed the project now. So that means that this project in work in process is now done. We're going to move it from work in process to the completed area where it's finally going to go, which is going to be building. So now it's no longer in work in process. We're going to take it out of one asset account, work in process, that has a debit in it. We're going to credit it to make it go down. We're going to put it into the building account, the building account then being the debit. So we're going to then record this. We're going to say, okay, we're going to move it out of the work in process. It's in there as a debit. We're going to credit it, making it go to 0. We're going to debit the building, making it go from 0 up in the debit direction. So we just moved it from one asset account to another. What's going to happen with the fund accounting related to this transaction? Well, nothing, because this is on the books as an asset. We're moving it from one asset to another. And the assets are long-term assets, which aren't on the books on the modified accrual basis, because we only have the current assets in the modified accrual basis. Now let's take a look at the capital project fund. We're first going to think about recording the final invoice. Now the final invoice, instead of debiting the work in process account, we want to put it down here as an expenditure. But before we can put it on the books as an expenditure, we want to reverse the encumbrance. So it's in there already as an encumbrance. This happens to be the exact amount, the $7 million, and then the job is complete. So we have to reverse that amount and then record the expenditure. So we got to reverse the encumbrance and the encumbrance outstanding. So the encumbrance outstanding has a debit. We're going to credit it, and then we're going to debit the encumbrances to reverse that. So we remove them off the book. So encumbrances outstanding, then going down to 0. We've got the encumbrances here being credited, it going down to 0. And now we can go ahead and record the actual expenditures that we want to record. So now we're going to say we've removed the holding account. Now we'll record the expenditure again. We're not going to record an asset, even though that's what we're making, a building, modified accrual basis. We're going to record the activity, construction expenditure. So here's the expenditure, and then contracts payable. So construction expenditure is increasing, showing the activity over the time period. The other side then going to the credit of the payable account, contracts payable, increasing in the credit direction. And then, of course, we don't have any transaction that's going to be moving from a work in process account to a building account, because those are two long-term asset accounts. We don't have either of them in the capital project fund modified accrual basis. And then the government-wide activity, back to the government-wide activity, F invoices paid and the retainer. So we paid the invoices and the retainer for F project. So we're going to pay it off with cash. So we're going to say cash is going to be decreasing, and what we're paying off is the contracts payable and the retainer. So we've completed the project. We're going to say, all right, now it's been completed. We're going to give you that $7 million of the final billing and the $750 that we retained from previous billings now upon the completion of the project, because it's now done and we don't need to retain anymore. We can pay it all off. So we're going to debit the contracts payable. We're going to debit the contracts payable for the retained percent and credit cash. That'll look like this. When we post it, we're going to say debit to the liability accounts. So these two have credit balances. We are debiting them, making them go down to zero. We then credit cash. Here's cash. We're going to credit cash, making the cash go down. Then we can look at this and say, well, what's going to happen in terms of the fund accounting? Obviously, we're thinking about the capital project fund. It's going to look much the same. Why? Because these two are short-term liabilities and therefore on the books for the capital project fund. So we're going to have much the same type transaction. These two are still on the books because they're current liabilities. We then are going to debit those and credit cash, same items. So we're going to debit the liabilities. Here are the liabilities. We debit them. They go down to zero. Then we credit the cash. Here's cash. We're going to credit cash and decrease the cash amount. Back to the government-wide activities. Now we have the contractor billed for B. So contractor bill for B. This is our second project that we have here. So we have the other project. We've got billing for the other project. Same type of transaction in the government-wide activities. We're going to debit the construction work in process, the asset account for the work that is still in process. It's not completed yet. And then we're going to credit the contracts payable. So it's going to look like this when we post it. We're going to say the asset is going up for the project that has not been completed yet, increasing the work in process. And then the contracts payable is going to go up as well, the liability, because now we owe on the second project the work in process for project B. What is this going to look like in terms of the fund accounting? Clearly, this is going to be going into the capital projects. We're going to have to record the activity in terms of not an asset for work in process, but an expenditure. But first, reverse the encumbrance, then record the expenditure. So it's going to look like this. We're going to say first we have to reverse the encumbrance. Encumbrance is on the books for $8 million, so it's not done yet. We still have some to do, but we have the progress billing so far is going to be for the $6 million. The $6 million, $8 million on there. $6 million is the amount so far. So we're going to reverse that. This is encumbrance outstanding, has a credit. We're going to debit it to make it go down. And then the other side is in encumbrances. It has a debit. We're going to credit it to make it go down. If we post this out, then we've got the credit for encumbrances. We debit it, decreasing it down to $2 million. Then we have the encumbrances at 8. We're going to credit it, making it go down. Now we can record the expenditure because this was a holding account for the expenditure. Now we can record the actual expenditure. That's going to be a debit to construction expenditures. Note that that's different than the government-wide activity where we debited work in process, the asset for the thing we're building. We're tracking the flows. The credit to contracts payable. So here we're going to debit the construction expenditures increasing in the debit direction, and then the contracts payable, the liability account, increasing in the credit direction. So that's what we have so far. We're going to move on next time to a closing process, and then we'll take a look at the second year. If you want to take a look at the transactions in the government-wide activity, here they are, and then the transactions for the capital project fund are here. These will be formatted in terms of the general journal. You can see the activity in the general journal. We have the beginning trial balance, the adjustment, which is going to be the combination of all the transactions in this time period in this general journal, gives us the ending trial balance.